Is everyone ready for a markets are not in turmoil special? We're going to take a look at what happened today, Friday, August 2nd. Big time sell-off. I'm recording this about 18 minutes before the bell. And I want to take a look at the positions that we have, what we're looking at. But in this view, let's keep in mind that pullbacks are not unusual. We're going to talk about how we measure volatility. We've got a lot to cover, but what I'm hoping at the end of this video you will have is a game plan and a way to understand volatility that doesn't bring up the panic, right? We're never going to make money panicking. We're never going to be able to manage risk panicking. So let's talk about what really happened today. So first of all, to take away the sell-off for a moment, let's just look at the normalized performance for the last month. And you can see all the movement lower, no question about it. If I were to look at a one-day normalized performance, the only thing for today that's in the positive territory of the sectors here on this chart is XLP, followed by XLU. These are defensive sectors. Now, if you take a look at the top three right here, those of you in the Sector Secrets Mastery know that our positions going into today were long XLV calls, long XLU calls, and long the strongest name in XLP staples, and that was Coke. So staples, utilities, and healthcare at the top of the list, and not so coincidentally, that is what we took into today, Friday's session. All right, now, a couple things to keep in mind with the sell-off, and this is really more of a macro and really sentiment / tantrum. What happened today? Non-farm came out and it was awful. So revisions were lower, average hourly wages were lower, unemployment ticked up, and the non-farm payroll number was lower than expected. Usually, up until this point in time, the reaction to negative, bad data in terms of jobs and inflation have been, if the jobs number is lower than expected, it sends the market higher. If inflation is flat or lower than expected, it sends the markets higher. It sends the indices, right, higher. It sends treasuries, gold, the euro higher. What happened today? Today was probably the first time that we had a miss like this, and the equity markets, the indices, did not rally because we as traders and investors have already discounted that the September meeting was going to be a quarter point cut. As we wrap up today's session, expectations for a 50 basis point cut in September have ramped up. The tantrum that was thrown was directly at Jerome Powell. You did not cut in July, Jerome. Now we're going to make you pay. You better make up for it. We want a 50 basis point cut in September. Whether we get that or not, the path has been set for a quarter point cut at least at the September meeting, a quarter point at least at the November meeting, and a quarter point cut in the December meeting. Now, we're going to see a little bit more of a full basis point, 100 basis points, or a 1 full percentage cut factored in. But really, it's pretty safe to say 3 quarter point cuts, or 75 basis points, or 3/4 of a point cuts will be what we get as we complete the December 18 meeting. All right, so that's where we are. So you might think, Rog, aren't lower rates bullish? They're not when you consider the tantrum. Basically, the market felt it needed to throw to let Jerome know how upset they are that jobs were amiss and rates have not already been cut. Remember, the last meeting was the 31st, which was just a few days ago. It was Wednesday of this week. And here's where we are. Now, remember what I mentioned about those stronger sectors. We're taking a look at 2 charts on this screen. One is the daily time frame on the left, and the other is the weekly on the right. I have to mention that when there is significant weakness, there's a saying, Wall Street is the one place they throw a sale and nobody comes. If nothing else, what happens is they return their items. It's an unusual psychology. Now, there are a number of things on the weekly time frames that are pulling back, and these are things that we'll look at going into next week. And when we have these pullbacks on the weekly, we have the opportunity to build a longer term position. So let's talk about time horizons. Rog, are you seriously going to tell me that you're bullish after today? No, I'm not bullish come Monday. I'm not saying that next week it's just up and away. But what I am saying is if I'm looking at a daily and a weekly time frame, not a 5-minute, not a 1 hour. If I'm looking at a daily and a weekly time frame, I want to go through the 4 indices. I want to go through the major sectors and the high concentration weighted stocks and find a few things. One, which are still printing green or yellow candles, meaning bullish or neutral candles. Which ones are possibly still in an uptrend? And then also which ones are pulling back to possibly sort of, I like to call it a wish list buy on my weekly chart. So if I'm looking at daily and weekly time frames, my time horizon is days, if not weeks for the daily, and possibly months for the weekly. So let's keep in mind that a lot of times the disagreement or confusion that arises based on market analysis is not being specific to the time frame and not being specific to the time horizon. I'm not talking about next week. I'm talking about the months to come. Rate cuts in and of themselves are not bearish. Why the tantrum? Because we haven't already cut rates. We got a terrible string of data this morning around the second mandate that the Federal Reserve has. Sure, we all know they have an inflation target, but did you know they also have a mandate about employment, which says, look, get to your inflation target, but don't implode the jobs picture while getting there. And now we've got evidence of our disapproval, our unhappiness about the way in which this Federal Reserve has managed monetary policy. Okay, that takes us through the first part. The second part gets us to the charts. Now, whenever we have volatility, and I'm going to warn y'all, this is a slightly longer video, right? But I really want everyone to realize that it's never a time to panic. And also, it's never a time to just say, well, the markets have found a bottom. What we want to see is volatility calm back down. So you might say, Rog, what's step one, right? Let's let volatility calm back down. Now, it's easy to say, hey, VIX, you went off into the stratosphere today. And it did, right? You can see the VIX pinged way up here. Take a peek at 2281. These are VIX futures. But let's be real. Did I need the VIX to tell me volatility was high today? I really didn't. In fact, if you take a look, not just at the S&P, but the NASDAQ and Dow, now remember, VIX are SPX options. From that, we get this fear barometer, this fear gauge called the VIX. Look how long, and I'm going to show you on the NASDAQ here, and we'll take a look at the S&P as well. Look for how long the individual daily candles have been breaking the daily price movement range. Now, for those of you that are unfamiliar with the DPMR or the daily price movement range, this is an indicator that I created well over a decade ago that calculates historical volatility. So there's a 68% probability zone where we stay roughly 2/3 of the time. And there are those times we exceed that 2/3 of the time, the 32%, if you will, and that's rare air. When we spend a lot of time in rare air, when we spend a lot of time outside of these gold and gray zones, that's increased volatility. The VIX just woke up today. The NASDAQ's been telling us we've had higher volatility since the 24th of July. All right, so let's take a look at the S&P, because the S&P is where the VIX really is in many ways calculated, because the SPX, the SPY, the ES futures, these are all the S&P 500. How long has the S&P been in a heightened volatility environment? Easily since the 24th of July. So today's eruption in the VIX is really quite delayed in terms of telling traders and investors that the markets are feeling pretty jittery, right? Red candle is a bearish participation, bearish candle. Outside those daily price movement ranges tell us that volatility has been high for a while, right? It's only now the SPX options are telling us, yeah, volatility is up today, but thanks, we didn't need that. We knew that, right? Now, that brings up another point. Is the S&P and the NASDAQ really where we have to look for trades? And this is really a matter of watch list building now. So if I'm trying to build a watch list and I'm trying to focus on where things are, one, not as volatile, and two, possibly in an uptrend, up until today in the Dow's been pretty well supported, and it hasn't been breaking those price movement ranges, those historical zones of support and resistance with the same frequency. It has been volatile, but you can see it's not as volatile as the S&P and the NASDAQ. So one thing is the Dow has been up until the 30th of July in an uptrend. And then you can take a look at the Russell. There we go. And you'll see something very similar. So yeah, lots of volatility these last 2 sessions. And you might say, Rog, this has been pretty volatile too. Case in point, once you start seeing the daily time frames exceed consistently the historical volatility support resistance range, go off into that rare air, that's a warning. All right, so I really want this to be not just an explainer for what happened today, but instructional going forward. All right, the next thing is, well, Rog, what do we do? Okay, you're telling us that volatility has been high for a while. The VIX is kind of the last thing to sort of confirm that. Yeah, it's kind of late to the party. So what we do and what we did, right, in the room. So it only matters what we did. So the alerts that we sent out to members were to focus on things that were more in line with where money tends to flow when there's fear. And that's going to be the XLP staples and the stocks within them. We want to focus on relative performance, and the XLU and the stocks within them. So XLP and XLU are very popular ETFs in terms of the defensives, right? And when things get really volatile in the broader averages, one of the best places to go are the utilities and staples. And as you saw before, month to date, even today, where is their support? It's support in these corners of the market. Now, granted, if you're day trading, if you're short-term trading, I'm not talking about shorts today. I'm not talking about how we trade a day like today. What I'm talking about is not knowing today is going to be a down day, and yet what are the signs that tell us, well, we're never going to know that today was the day we're going to see a 600-point drop in the, I'm looking at the bug on the bottom of the of CNBC right now. We don't know that we're going to have a down 740 day in the Dow, right? We don't know that in the beginning. But what I'm saying is, how do you prepare? How do you position yourself for the potential for these types of events? All right. You look at when the volatility goes up based on historical price movement ranges, say, okay, where are the defensive opportunities? So case in point, the long positions that we had going into today were calls and XLU, which actually are doing fine. A lot of volatility, but still overall punching up to higher highs, and they're going to close above the previous session close. Not many stocks, not many indices can say that. Not many sectors even can say that. The other position that we had was the best performer in staples. There's 3 stocks in staples that are doing really well right now: Coke, Philip Morris, and Altria. So we have a long position in Coke. Take a look at Coke here. It seems to not even be aware of the 700 plus point sell-off in the Dow, right? So what happens? Money doesn't go under the mattress. It seeks out places where it can hide out sometimes, and these are 2 very popular hideouts. And ultimately, I'm going to stick with the staples and the utilities as long as the volatility is high. It makes sense to look for pullback buys in these places. So we know that the Federal Reserve is likely going to cut. We're expecting 3 quarter-point cuts at least over the next 3 meetings, right? Quarter-point each, or a half-point cut in September, and then a quarter-point cut in November and a quarter-point cut in December. That's mostly what's being factored in after today's non-farm payroll. Is it time to panic? Not in the least. It's always watch list building time. Always. Where is the money flowing? It doesn't just go into nowhere, right? It doesn't go off to La La Land. It's going to find somewhere to go, and we're finding that staples and utilities are continuing to benefit from the uncertainty, from the chaos that's happening in the broader averages. Now, the next week, once we get past Monday's session, heads up for Tuesday's free video and premium video, because we're going to talk about where, if anywhere, there is strength in the indices or even under the hood in the indices, what individual sectors and what individual stocks might be showing recovery first, because it may not be broad recovery. It may not be the Dow just bounces from here. So we'll be very selective about building those positions going forward. So I really wanted to take some time and give you all a markets are not in turmoil special. The last thing I want to show you all as we wrap up, and this is something everyone can do, okay? Different platforms allow you to anchor VWAPs, volume weighted average prices, on the daily time frame or even on the weekly. So I'm going to show you how far above the VWAP we are on the daily time frame. And another thing, if you want to pause the video and take a look at these labels, this is something we call the sanity check. How much have we pulled back from the highs? At 50, 54.22, right, where we sit. Let's see, where are we sitting right now? Yeah, about 54.71, sorry, 54.71. Have we even made a 5% pullback on the ES, right? So also kind of look at how far we pull back from the highs, and then look at where we are in relation to the anchored VWAP. The one that's the most volatile is the NASDAQ, and the NASDAQ is still hovering above that anchored VWAP. You can see what we've done here before in terms of breaking it, chopping around it, and then getting back above it, and the subsequent rally that happened once we got back above that anchored VWAP. And then in terms of the Dow, trading right now at 18,967, right? You can see we're right there with that 10%. And these are ultimately the kinds of things that, again, I don't want to panic. If I want to short sell, great, day trade, short-term swing. But where are we heading weeks, if not months to now? And that's what I really want to put some perspective here. Sometimes you step back and see the forest for the trees. That's what this is. And if you have any questions, feel free to leave them in the comments below. I do check and answer them personally. And I just want everyone to keep their heads up, look for where the opportunities are. It's never a time to panic, and it's certainly not time to panic now. I'll see you in the next update.